Boy, what a finish we had to the week here. A nice little rally, especially in the S&P 500, that really kind of kept us bullish going into the weekend and going into a new week. The question is, how bullish was that rally? Was it enough? Was it enough to stave off a transition that we seem to be going through, where the weakness in the NASDAQ is starting to spill over into the Russell and potentially into the S&P? So that rally staved it off on Friday. But was it enough? Was it enough to fully stave it off to start a new intermediate run? So that's what we're going to break down today. We're going to take a look at multiple indicators in conjunction with each other to see if it's confirming that really strong, basically, hour of trading that we had going into the weekend. So we're going to break that down. We're going to break down the rotation that we're seeing not just in U.S. equities, but in other asset classes. There's a rotation going on right now, a little bit of a stealth rotation. So we're going to break that down and what it means for us. And then our trade idea of the day is a stock that took advantage of the rally we had at the end of the day. And so now the question is it enough to stave off the bearishness? Was it enough to start new bullishness? And if not, how do we trade it? So we're going to talk about that with our trade idea. So let's go ahead and get started. Today is Friday, March the 26th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, that late rally on Friday really got us up to previous highs. We've seen a move like this before, actually, when we, over here during this little pullback to the 30-day moving average. We didn't quite go below it. Similar to here, we actually closed a little bit below it there. But then we had a really strong rally the next day up to the previous highs, just like we did right now, closing above a bunch of different highs. Same thing here, closing above a bunch of different highs here. You had, on this day here, you had short-term, in fact, you almost got an overbought cluster. We were just barely not getting an overbought cluster because of the near-term line sitting at the 79th percentile instead of above 80. Everything else was above 80. Well, here you have everything, it looks like, above the 77th percentile, not including the market sentiment line, of course. So very, very similar pattern. We'll see how this plays out this go around. But needless to say, you're back to dark green shading in the green line on the S&P. On the Dow, too, the Dow never really did, only got light pink shading, and you're even closer to an overbought cluster on the Dow. You ended up with, at the 78th percentile for the intermediate line. The other two were in the upper reversal zone. But that's not the case for the others. Like the NASDAQ, you can see the nice little strong move, but we didn't get up to new highs. We didn't get up above these. Remember, the S&P got above all these highs. The only high it didn't get above was the 17th of March. Well, here's the 17th of March here, that high. And so all these highs, the S&P actually did get above. Not the case for the NASDAQ 100. Then you look at the Russell 2000 and you say, okay, well, where's the 17th here? There's the 17th. So all of these highs right here, the S&P got above, but not the Russell. And the Russell still stays below its moving average, and you still got dark pink shading in the red line. So it kind of puts in the context that rally. Not nearly as strong as we think it was going into the weekend there. Obviously, short-term sentiment improved quite a bit, especially on those industrial type names, the Dow Jones industrial type names. But, you know, if you look at the short-term sentiment for the NASDAQ, not very bullish. You look at the short-term sentiment for the Russell, looked better, but at least it's in the upper half of the chart, but still not very bullish. And for these two indexes, you can see the market sentiment line is declining, and it's still declining on the NASDAQ, but it's rising for the S&P and the Dow Jones Industrial Average. Barely, just barely rising, but it is rising. So you do have a little bit of a return to some better sentiment from a long-term perspective on these indexes. But take them for what it's worth, right? Again, remember, you get your bigger moves when you're below the moving average, and you got a pretty decent-sized move on the NASDAQ compared to the day before. The Russell, not so much. The Russell's actually a smaller move on Friday versus the day before. So take all that with a grain of salt. When you take a look at the weekly chart, let's go look at the weekly charts here for the Russell 2000. You can see that near-term divergence here still playing off of that overbought cluster, intermediate cluster, or overbought cluster with all three lines there a few weeks ago. This would have been back, looks like the first week, second week in February. We got a higher high, but associated with lower near-term highs. When you look at the S&P 500, same thing, right? You've got higher highs here associated with potentially lower highs on the near-term line. The first one being an overbought cluster, the second one being barely in the reversal zone. And then let's look at the Nasdaq 100, which has been the weaker one. So it's also got the overbought cluster on that same week, February the 8th. But we are not getting higher highs here, so it shows a divergence on the Nasdaq. We are much lower on the high, and the near-term line setting up for what would be a very significantly bearish near-term high point. That would only be between 50 and 80, and would be corresponding to an obviously much lower high point there. So it kind of keep an eye on some of these long-term indicators and what they're telling us going into a new week. That there's some long-term divergences that are playing out that may take a week or two to play out, because remember, this is a weekly chart. It takes a week is 5 different days, so it's going to take some time. It's hard to turn this around, almost like a ship in the Suez Canal. It's hard to get it going, and it doesn't move on a dime, right? And so on a daily chart, it's a different story, and we'll see how quickly that short-term sentiment either confirms itself going into Monday, or we have a very similar pattern to what we saw on the 25th of February, where we had that nice little bounce up and then a turnover. And you can see on the 25th of February, that was the day that pretty much started the intermediate decline for the Nasdaq, because we got dark pink shading in the red line, and we finally broke below the 23% Fibonacci retracement level, easily below that. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when these videos are posted. Also, while you're down there, hit the thumbs up icon. That tells us two things. It tells us that you liked our video, obviously. And number two, it basically lets us know that you want us to do another video again on Monday. It's a quick way to give us feedback. If you don't like our videos, of course, you don't have to click on anything. But if you do like our videos, we sure love to know it, and you can let us know with one click right now while you're watching, just by clicking that thumbs up icon down there. Also, too, while you're down there, comment. What did you get out of the video today? What stood out to you? Or what questions or comments do you have about anything I talked about? Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle here at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, I also invite you to check out some of the other things here on the site, including our trading rooms over here on the right and our Market Outlook live videos. Every day I do a Market Outlook. I do a Market Outlook live video. I review all the existing trades that we've done in all these videos. I do a trade at the end of every video. And then we continue to manage the trades afterwards in this live video. So every day, Monday, Wednesday, Friday, 3:30 Eastern Time, all of our paid subscribers get access to those videos, as well as all of our trading rooms. Our premium subscribers obviously get access to more, but all of our paid subscribers get access to those things over here on the right. Come over here, click this heart. It opens up a new tab. Hit that like button right there. Also click on this thumbs up icon. It opens up another new tab. Hit that like button there as well. Again, the more you do that, the more engagements our posts have, the more people that follow us actually see our content based on how their algorithms work. It also benefits you when you do that, and we really appreciate that when you do. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, let's take a look now at the weekly chart here, the Hakinyashi chart, and you can see the S&P 500 getting a little bit of a transition candle. Now, take that for what it's worth, because usually transition candles are bearish, and this one wasn't, right? So take that one for what it's worth. It's a relatively relative transition candle. Not the case for the Russell 2000, though. As you can see, we did get a bearish candle this week. Still got a long lower shadow, and that's why the Hakinyashi also has a long lower shadow. But lots of times, long lower shadows at the top of these bullish moves tend to be filled in. Right? We continue to trade in that range, and the bottom of that candle will act as a support level. Considering that PPO is so very high and rolling over, very good chance that we continue to fill in that range there. The NASDAQ 100, you can see another transition candle. It's kind of stuck here between its 23 and 38% retracement levels of this intermediate run. You can see the lower shadows go all the way down to the 23% line of the long-term run. That's in blue. Falling long-term momentum would suggest it will probably trade in that range too down there. So we'll kind of keep our eyes on these long-term charts heading into a new week. You can see from a 3 green arrow standpoint, we did get a new set of 2 green arrows, almost a third one with above average volume there. This is what the 2-line version of that chart looks like. MACD turned up, stochastics turned up. They're not above their moving averages yet, but they turned up pretty nicely. And we obviously turned back up above the 8-day moving average. Let's look at the Russell 2000, and you can see all we did was get up to the 8-day moving average. So, again, you get biggest moves when you're down below the 8-day moving average like this. And so that's what happened yesterday. And if you include today kind of as one, that's a pretty decent sized move because we were so far below at yesterday's open, below the 8-day moving average. And we made a run back up there. But the stochastics and the MACD are easily well below their moving averages and not anywhere close to crossing above that. The NASDAQ composite, the MACD is above its moving average because we've been kind of sideways here for a while, but still below 0. So it's been unable to really get going, and you can see the stochastics had been above its moving average too, but it's since crossed down below as we come off of these lows. We have been below the 17-day moving average. We have been above it, broke back down, got barely back above it here. So now we're going to stay above it, right? If we stay above it, great, because we're most likely to get above the 30-day moving average too, and eventually back above this dotted line, and you're going to feel a lot better about things. But considering that's been unable to be the case here the last few times we've closed above these lines and we've been unable to get above the 23% line and stay there, that seems to be unlikely, especially with these indicators kind of falling back. Let's take a look at some of the other indicators. As we mentioned in our technical analysis class on Friday, as bullish as it seems on the market forecast, we're not quite getting the confirmation of that bullishness on these other indicators, as they're pretty much in neutral zones. And the Russell's is barely back. It's kind of in the lower end of its neutral zone, but they're all kind of in neutral zones. So none of them are significantly bearish, but none of them are really bullish either, obviously, except for the S&P to an extent. So it's at the top end of its neutral zone, but not in the bullish territory, which would be above 60 and above 100 on this. So we're not quite to that point. And obviously the S&P is not giving us a directional move either. Like the ADX is very low. It's not rising. The negative index is still up above 25. The positive index is still easily below 25. It's hard to be too bullish with that pattern, and we've had that pattern for a while now. And you can see the NASDAQ especially has had that pattern. It's actually been so more pronounced that the ADX is above 25. And then you can see now that the Russell 2000 is also getting that pattern with the negative index above 25 and the positive index down here below 20. So that's what it looks like when you're bearish, and that's what it looks like now when you can see it has a rising ADX because there's a pretty decent sized gap here. Like we have kind of started a little bit of a breach into bearish territory last week, just barely. But not, we didn't sustain it, but just barely had a little breach into bearish territory, and we'll see if we follow through on that again going into a new week. Came very close to a new 4-week high on the S&P 500. There's that nice little rally we had after filling in most of the morning's gap, the nice little late rally here. I got a lot of questions about that on Saturday, and a common theme was I just do not get worked up about one-day moves, number one, and especially don't get worked up about 1-hour moves, and that's essentially what we had. We're going to get, we're a lot closer to the high than we are the low, but keep in mind that, barring a new high, that low, by the end of this week, that low point is going to be at that level until that day's over with, and it's going to be all the way over here again. So we're going to get, again, that Arun indicator, which kind of graphically tells us where the high and low tags are. We'll get another one of these where the red line crosses up above when the new low comes over here on this side. Remember, for IWM, we're getting very, very close, as you can see what it looks like there. But when you look at on this chart, IWM, that low point by the end of the week will be gone, and this will be the low point, and we're nowhere near a new high point. So we're going to get a bearish crossover there. The question is whether we'll get a new low point. Again, you can see we kind of stalled at the midpoint of the 4-week range If we can't break through that going into Monday, then look for that to hold, because you always look for resistance and support to hold until they don't. And then we'll flirt back down to this area. There's very little volume and very easy for it to move lower. The QQQ broke through at the very end of the day, the point of control. Again, is that a false breakout, a fake out? Or are we going to hold that breakout and get a new high? You can see the high is going to come off, and the high is going to move over here to the right of the low tag, which we haven't seen for quite a while. Because remember, the Arun indicator had the bearish breakout on the Qs a while ago, and we're about to get the green line to move up here. But that green line is not going to get all the way to 100. As you can see, the high is going to move over. So for the green line to get to 100, the high would have to be on the current day. So the high is going to move kind of in the middle of the range. It's still going to be on the right, but by the end of the week, then you'll see the low come here, it will come here, and then it will come over here, and the low will move back to the right, barring any new lows today or this week, early in the week before this high comes off the table. It only takes another day for that high, or 2 days here, for that high to come off the table there and to get that bullish breakout. I just don't think that bullish breakout is going to be very bullish, as it will lack the break to the 100 level, which is what turns things around again, right? It lacks that. It'll probably come up into this area here and not really get going, and potentially start rolling back down again without a new high being formed here later. Let's take a look now at the volume and trading range today. Above average volume at 114 million, and the trading range over 6 points. That's above average when you look at the average, just under 6 points, and the volume at 105. So slightly above average in the volume, slightly above average on the trading range. Not surprising, because when you're below the moving average, that's how it works, right? But even then, today's range on the Russell was much smaller. It was actually below the average versus yesterday's, which is well above the average. So when you're below the moving average, you tend to get bigger moves. But look how big the ATR is right now, flirting with 3% of the Russell 2000. To kind of give you some perspective, that's relatively high for the Russell. Like, we are in bearish territory. The volume is high, relatively speaking. Again, barring the COVID high. If you look at the volume in the trading ranges and you compare them to some of these other levels, this is like peak bearishness on previous intermediate runs, like especially those two in 2018. That was peak bearishness, and we haven't even started a pullback, right? We briefly breached it on Wednesday. We haven't really started a pullback, and we're already at trading ranges and volumes that are at similar levels to peak bearishness on previous pullbacks. Kind of shows you what we have to look forward to on what the bearishness will look like when we actually do get one, when a pullback that starts. The volatility index dropped down to finish at really low levels. It always seems to finish lower on Fridays, and then we'll see if we bounce up. Last Monday, we actually fell below 20, fell back below 20. But you see how, as we've been getting progressively more bearish on a absolute basis, we've been gradually getting less bearish on a relative basis. A little bit of divergence, which suggests to us that the volatility now is lower than it should be. According to this chart, which is a relative chart of VIX to the longer term volatility index, according to that chart, we should be up here in volatility, and we're that much lower. So I expect that divergence to play out with a higher move in volatility, which typically coincides with some weakness heading into next week. All right, so just to summarize our technical outlook before we look at some of these other charts and different asset classes. Obviously, we had a little bit of a bounce back and a snapback on Friday. I don't trust short-term moves, especially at the end of a week, especially with that takes place pretty much over the course of a single hour. So we'll see whether there's some follow-through on that. But I expect that this exhale that started exactly a month ago in the NASDAQ 100 has already now started to bleed over to the Russell. We'll probably see more of that sustain itself this week. And then eventually, over the course of this next week or two, we'll see it start to bleed over into the broader S&P 500, to broader risk-off moves that we're starting to see across different asset classes as well, as we'll see here in a minute. So, when markets are bearish, when we're in pullback mode, that doesn't mean that every day we go down. There's going to be bullish days. In fact, there's going to be bigger bullish days than we've ever seen. That's okay. That doesn't. We don't get worked up about one-day moves. We don't get work. We don't change until we see this process show us that we should change our minds. So that's kind of where I'm at, and I'm expecting that weakness with some short-term pops like we've seen. Whether short-term means a day or short-term means an hour, we'll get short-term pops because of the nature of trading below moving averages. But until things turn around, I expect that we are just starting intermediate pullback mode, and it's going to be a process. But I think we're still in the beginning of that process. Definitely not towards the end of it. So what do you think? Do you agree with that assessment? Do you disagree? Let me know that in the comment section. In the comment section below. Comment. What do you think? Do you agree with that? Do you disagree? If you disagree, especially, let me know what you're seeing. Like what charts or indicators are you looking at that tell you why you're a lot more bullish than I am, or if you're a lot more bearish than I am, what are you looking at that tells you that? Let us know in the comment section below. All right, let's take a look at how the week performed. It's kind of a tale of two halves. We had some initial strength, interestingly enough, with the NASDAQ early, but weakness on the IWM. Bonds and the NASDAQ actually finished this Monday the most bullish. But then over the next couple of days, we started to get more and more weakness in equities into Thursday's low point. Small cap stocks were down at one point more than 8% for the week. That was a significant decline, whereas the Qs were only down 1.5%. So you can see where the real weakness is right now. It's in that Russell 2000. But emerging markets also been struggling, underperforming developed markets. You can see commodities started the week strong. They had a little bit of a pop, had another leg lower, and then a little bit of a pop. So that seems to be a common, really volatile moves right now, but bearish overall on commodity prices. Gold's down because the dollar's remaining strong. Dollars had a really gradually strong week all week, and real estate and bonds finished the week relatively strong too. So risk on move, even though stocks rallied late, especially the S&P and the Qs ended up almost 1% higher in the week. But your IWM still finished the week, even with that late rally, down nearly 3%. So definitely a risk off week despite the late little jump in risk appetite going into the weekend. Let's take a look at some of the charts for some of those different asset classes. Let's start off looking at the dollar here. Just give me 1 second to pull that chart up. You can see the weakness we got, and a little bit of a bounce back we got on Friday, but still, despite the bounce back, we still got an oversold cluster, right? The near-term line jumped up, but not enough to get out of the reversal zone. So we still got a cluster there, and we're still down. We're still well below the 30-day moving average, which means we'll get pretty decent-sized bullish moves. That doesn't mean the dollar is tanking, right? It just means that we're holding support as of right now. This is the area we've targeted. Right? We've been looking for the dollar to get to that space. I don't think we're done trading at that space. We could bounce up. We could bounce all the way up here to the 50% line, this 23% retracement of the longer term move. But that's probably going to be our ceiling on any bounce up. And more than likely, we'll probably just bounce up to this 62% level. And then we roll back over and test again in this area, maybe even a smidgen below it down to this 117. I don't think we go below 117, and I only think we touch that on most mainly an intraday basis. But I don't think we're done trading in here. I think we will be up and down in this area for a while as the U.S. equity market begins and sustains its own intermediate pullback. We talked about commodity prices, but let's take a look at crude oil. Crude oil has been really volatile, up and down, a lot of the Suez Canal, but you can see how it's flirting with breaking its 23% retracement level and starting its own intermediate pullback. You've got dark pink shading here because we're easily below the 50-day, but we're not really able to sustain a pullback here down to a little bit lower level. Here's the commodity index. It has not broken its 23% level, and we don't have the red line yet. So the commodities have been so bullish that it's not going to be just that easy to have its own pullback. The gold's had a little bit of a rally, but I see that gold coming up to these levels of resistance and holding in the short term as the dollar again, and trading in this area here as the dollar trades its own up and down moves before gold takes off later once the dollar also starts to make a new lower low. In this case, the euro. So I think on the euro US dollar, I think that if I can type it in right, I think we'll be down here for a little bit of time, but I don't think that we're changing the trend on the dollar. I think eventually the euro will find this low point and really take off again and make a new leg similar like this to the upside by the end of the year. So we're not, I don't think we're changing. I'm still very bearish on the dollar. That still dictates a lot of what I'm seeing. And obviously the recent strength in the dollar has impacted EEM, emerging markets, negatively, but nothing more than a pullback, right? Nothing more than... you can see the long-term pullback here. We haven't even broken the 23% retracement level of that yet. We obviously have started to pull back on the intermediate basis. We have dark pink shading in a red line or below the 23% line, but on a long-term basis you can see we're still holding, which means we have still some more room to fall on this down to this 48.5 level before we're out of the woods yet, before its own intermediate decline is done. As you can see, we've been forming clusters and a little bit of a pop in short-term sentiment, but I don't think that's going to last very long. Remember, you get your biggest moves to the upside when you're below the moving averages, much bigger than you see when you're up above them. Interestingly enough, when you look at the sector rotation, then you really see, oh, okay, this was a risk-off move. Obviously, for most, late we had a big rally in XLK and XLC really struggled, but XLK, XLI, XLB, a lot of these energy, materials, healthcare all rallied late. Financial struggled, discretionary and communication services struggled all week long. But look at what your best performers were for the week. You had utilities up there, and you have real estate, and you have staples. Those are your safe haven areas. They were the best performers pretty much all week long. They finished the week pretty strong. That kind of shows what we're seeing here. When you look at the 12 grid for this chart, and you can see, the moving averages are rolling down in these cyclical areas. XLC is finally giving us light pink shading and a red line. Right, we're close to dark pink shading and a red line. That we're that close to getting dark pink shading on XLK and XLY if things roll over, and that I fully expect that they will. Whereas I think we're getting divergent highs on materials and industrials, potentially lower highs on energy and financials, as we were so parabolic on these previous highs that I think that those are our peak parabolic moves. When you look at like the directional movement index here on the 1 year chart, you look at like XLY, you can see not so much of it as significant of a peak there. When you look at its weekly chart here, you can see we've had more of a bearish move. Let me look at bullish move, excuse me. That's about as peak as it's been. Obviously not as big of a directional move there, but you can kind of see what industrials looks like. Look at energy as parabolic, relatively parabolic it got there. Materials as well. And then finally financials, the most parabolic out of all of them. So I think a lot of this will just be kind of consolidating these big moves over the next little bit, and you'll see a consolidation or rotation into some of these other areas that you see on this graph. If I were to pull up the sector rotation chart and look at it on a daily basis, again, you can see industrials, materials, financials, energy all losing relative strength right now, going down to the left, and then you've got your safe havens are the only three in the top right. So we are in rotation mode to safety, and your cyclical areas will kind of hang in there. They won't go down as much because they don't have as much to lose, but you can see where the rotation is coming out of and where it's going into right now. All right, now let's take a look at our trade idea for the day. I'm going to take a look at Adobe. Adobe, you can see had a nice little rally today too. It's to the point of light green shading and a yellow line. So with that light green shading and yellow line, which is a pretty bearish pattern coming off of earnings, you would look at that as that's a nice good move to the center, pretty much to the center of this recent range, sideways range we've been in. Good bullish, looks like a good bullish breakout type pattern here. Very long term, highest momentum line that we've had since way over here. That's a good move. The intermediate line crossing above market sentiment line. You look at the 2-line version, we got easily above the 8-day, 17-day moving averages, and the 30 for that matter, closing above all these highs. You can see the MACD and stochastics rising. You take a look at The directional movement index, though, and you can see we've been on the pretty strong bearish move. The positive index is still pretty high, up in, close to 25, but it's not above 30 yet, and the negative index is easily not below 20. So, I don't put a whole lot of trust yet in that bullish move. You can see we are above 100, but we're not above 60, so we're not quite to bullish breakout mode on a lot of these indicators. If you take a look at the trend strength indicator, we were in a strong bearish move, and now we're not. So it seems like we are kind of falling. We had a strong bearish, bandwidth was falling, and now it's falling down. And look what we got. We've got strong support below us, the low point of this range. We got very strong resistance above us, and a very big volume node in the middle of this multi-month range. Obviously, you kind of know where I'm headed for that. When we got that kind of sideways technical action, that sets us up for selling some vertical spreads off of it. So if I look at the April expiration, which at the time still had 20 days left when we did this trade on Friday, our premium subscribers got this trade idea early Friday through our Telegram. Usually we get these trade ideas before the market closes when I do the Market Outlook live videos for all of our paid subscribers. But you can see we sell the 20 delta. What at the time was a 20 delta. 435, 430, sell the 20 delta over here again at the time at 490, buying the 495. That sets us up for, let's just go to a single symbol and show all these trades here eventually. See if I can, I don't know why it's not showing up there. There we go. Full position size, so we don't have to worry about earnings, and you can see the return we're shooting for, $400 out of that, and what we've got so far on it. So it's a little bit of a gain so far on this trade, and that's where my break evens are. My break evens are these lines, these blue lines right here, and you can see the blue dotted lines are the lines that I've drawn that kind of are the high and the low of this range. A little bit of a dip there. But pop right back up, so it kind of shows just how important that support level is at that Fibonacci retracement zone, and we've come well off of that. So, and again, like I said, we've got a very strong volume node stuck in the middle of this range that can help keep us in this area. So I like this opportunity because we're not bearish anymore. That's what this breakout move has kind of showed us on Friday, but it's not bullish enough of a breakout to say that we're really going to start trending higher. So it doesn't look like we're still. It looks like we're still stuck in a very sideways range that we can take advantage of. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum on our community page. Remember, all of our subscribers, even our free subscribers, get access to that. We want that so that you can be able to interact with each other, other people that are watching this video. So open up a thread there with any questions or comments you have, reply to other people's threads, and let's keep this conversation going in between videos. As always, thank you very much for watching. Or remember to subscribe to our YouTube channel, hit that thumbs up icon, and like us on Twitter and Facebook too, and comment on the video. Have a great rest of your weekend, everybody, and we'll see you all on Monday.